everybody, hope we're all doing well. James here from LAGFX, and as I promised, I'm going to be bringing you all an exclusive case study video for all of you here in the Learning Lounge. So today I've gone for a slightly different market than what I would usually want to look at, and the reason why this popped into my mind is obviously because today is a bank holiday in the US and Canada. So as we sort of rear towards the end of the London and European session, we're going to expect volatility to die off quite massively, and therefore I thought I would do a top-down and case study on a market that is relevant right now. So Great British Pound to Swiss francs. We've got obviously the standard currency in Great Britain as well as the Swiss currency there. So two currencies that are active right now, so we can see exactly what's happening, exactly what my predictions are, so on and so forth. So starting off here on a 3-month time frame, going all the way from back in, I believe, 1972 there, where the data starts. Obviously we can see we had a crazy spike of volatility within these 3 months, and what's happened there is we've had a major move up, and ever since we have been trading lower. Now we may want to make the assumption that this move lower comes to mitigate a position lower, or it may want to just come and liquidate. We have absolutely no reasoning to believe either side at the moment, because we don't know whether this market wants to be bullish or bearish longer term. Obviously, as of right now, however, we see that price has been trading as bearish for quite a long time, or pretty much since 1975. So we're looking at a good 47 years there that this market has been bearish, and we can see that price has been constantly reacting with different supply zones in this market. So as we go lower, we're going to start to notice that there are regions in the market where we have some zones left over. So for starters, we have a major buy to sell at this region. Also, if we use the wicks here, we see we have a buy to sell somewhere within this region as well. Now, we understand that there is market inefficiency here. There is two unmitigated zones. However, they're likely not to be mitigated until price delivers us with a more full correctional wave, which it doesn't appear that it wants to do for some time now. We're potentially talking about years until that happens. And obviously we're not going to sit around for years waiting for potential entries. So looking more recent, we have a last buy to sell candle in here, which has recently been mitigated. Since that mitigation, we have come to liquidate the low, therefore making this a protected high. So working within that, let's drop down timeframes once again to view this in a better format. Now we've had the mitigation, and then we've had bearishness created from there. So we're working within this as a protected high, this as the current target on this time frame for price, which we are approaching right now. I stated this as a protected high. Looking inside of here, we can see that from where that wick is, we've had a move up from that wick up to that region there, which we see is a zone that has been mitigated. The reason why this is valid is because no structure returns into that after its creation. So we've had the mitigation of that. We've then had the reversal lower. So we're working within this bearishness. Everything appears to be mitigated from here as we move lower. Let's focus in on price as of current. I'm going to go down slightly lower and say there's likely going to be something within this region of a last buy to sell. That does need to be mitigated. As stated, there's no other obvious zone or region in the market other than potentially all the way back up here, but the likelihood of that happening is relatively slim, although we can identify it on the market on the off chance that it does cause some form of reaction. We also do have some inefficiency below, a lot of liquidity created below the zone as well, so that could be a nice indication that price wants to run it at some point. We'll just have to see what price does moving forward. But as stated, here we have a zone, and this is pretty much the closest zone I'm seeing on this time frame that would require some form of mitigation. So we'll add an alert at that level. we're then going to go down to a 1 hour to view price more recently. Now, what is the structure telling us? We have impulse, correction. This comes to break the low. We break the low once again. So we're viewing this as the recent impulse, or more specifically, from this high here, as there's nothing that needs mitigating above, we're taking this as the most recent impulsive wave, all the way down to this region. And now let's look inside of there and see if there's any positions that need mitigating, which I would argue we have a buy to sell at that point. Add an alert, 1.1343. We will change this to a supply zone. Recently had a change of character delivered by price penetrating this level, which is confirmation enough that price should now be creating a correctional wave. That correctional wave, we hope or predict, has the purpose of mitigating this position before then making moves lower once again. However, it is worth noting that as of recent, volatility has died down massively. Evidently, we are entering an oversold state of the market, so it's whether we have enough supply remaining in this move to eventually continue price down to this target to exceed the low that was created a while back, or if we're going to see price accumulate here because it doesn't quite have enough supply, that accumulation bringing price up to potentially mitigate out the position up here, or on the off chance that anything is remaining along this level. Having a look at it quickly now, I would argue that we also have this as unmitigated inefficiency below, no price action returning. So given that we need some more supply in the market and we see price starting to break some of these highs, liquidating these levels, that's then where we'd be saying, right, let's zoom out, let's look at the bigger picture and try to find where price may want to come back up to A, rally enough supply in the market to cause that move lower, whilst B, also mitigating some positions that have been left over prior. So just returning back to our bias as of currently, we have a perfect buy to sell there. We've had the change of character, therefore confirmation that a correctional wave is incoming. We can now view this as bullishness, this being a protected low in the bullishness. Now, given we wanted to take some scalp-like trades, we could then be viewing this structure itself, saying, right, so within this bullishness, where is there any unmitigated positions remaining? The only region where we could argue that there is somewhere all the way down at this bottom level. That is arguably where the last real sell to buy starts. If we go to a higher time frame, we may be able to view that in more detail. Just using the wicks here to see exactly what has happened. We've had a large push up, followed then by some major pushes down. Okay, so this is going to be quite hard to determine. There's definitely nothing remaining in these regions. Down here, we could either be identifying this sell to buy or the one at the very bottom. So that's going to be completely up to you as to which one you want to identify. It sort of depends what we go off here. Although I think for me personally, the way that it appears to be, I'm probably going to draw out this region as valid demand. Whether you agree with that or not is completely your decision. So, as we know with structure, we're either going to continue following the fractal nature, which we would see is this, or if we want to break that fractal nature, it could be for the purpose of delivering a higher time frame correction wave. So rather than viewing this fractally and saying impulse, correction, so on and so forth, we're saying this is a single impulse, this is a single correction to mitigate out this position before giving us another impulse up into that region. However, if we decide that we want to actually follow the more fractal nature, that is then we'd then look inside of here for any positions that remain unmitigated. There's nothing obvious. Let's go down to a lower time frame. I guess this is a major sell to buy that remains, which arguably we could say has been mitigated, because if we really look inside of here, if we were to take that zone, this wick comes back in, mitigates that out, so we could actually instead argue that this is the last region that has mitigated a position but not been mitigated itself. Looking along, we've had potentially a nice accumulation here where we have come down, created a level of support in this region, so our lower boundaries of an accumulation. We've had a nice spring here, test of the spring. So if we see this level get broken, which should be a protected high, we could then argue that yes, we are seeing a reversal in the market. So if that high gets broken, we'd expect to see price then trading up. We could then look for mitigation back down for an entry and then try and take a long position all the way back up. That all depends how you'd want to go about this. Looking inside of this, it does look like a very, very nice accumulation. We've had the mitigation of that zone. When we've created that spring, we've left a sell to buy, which has been mitigated out by the test. We've then had another move higher, which will probably come down to mitigate us into this region before taking its next move up, which will hopefully take out this high, confirm a fractal change of character, and then we can start looking for entries where we may be able to find something refined by like a 5 pip stop. And then obviously if we're expecting within our bias for price to come all the way up to here, looking at a 50 pip take, something like a 10 to 1 trade or a 1 to 10 trade we could have here. And that is completely just from a top down analysis where we have worked down from the higher time frames to the lower, so starting off on a 3 month, ending up all the way down on the 15-second. So this is what I recommend to everybody when doing your analysis. Start off on those higher time frames, work your way down, and now we understand we have a solid bias, we have a solid story of what we want to see price doing. And as stated, as of right now, we're hoping to see some form of accumulation in here, change a character to the upside, finding an entry, and then we could potentially trade upwards. However, this is much more of a scalp like trade where we'd want to also be taking partials, because we are predominantly trading against the higher time frame trend. Therefore, we may want to include extra safety measures like partials, because we understand that yes, we are working within our bias, that price may want to trade up to here, but we know that longer term this market is heavily bearish. Therefore, we are potentially trading against a trend. I hope this case study has helped with your own bias on this market. I know this isn't a major market that the majority of us probably look at, but in moments like this where we're seeing bank holidays in the US and Canada, where the dollar and the Canadian dollar are going to be very unvolatile, we have to go to some unconventional markets like this, and even just taking time to analyze them to help ourselves getting used to analyzing the market and performing that top down. So if you enjoyed, let me know. If you have any questions about any concepts or anything I do within my analysis, again, let me know about that. And best of luck to everybody in this trading day.